Oh boy, we've got some news out of China. Welcome everybody, thanks for tuning in again. I really appreciate that. Smash a like and share this video on investment channels that care about China or in general about the stock market. So let's jump straight into it. Overnight we got the news here. China's central bank reduces bank's reserve requirement ratio by 50 basis points and well, the indexes reacted very bullish towards that. So we've got the HSI up more than 4%. I think one of the best days since 2020 or 2021. The Chinese local indices like CSI, the Shenzhen component, all of them up 4%. So that's big for an index. So it seems like this is a strong reaction and that people have, liked those fundamental changes here. I obviously spoke about this on my channel before, that after the third plenum, I expected more and more stimulus or positive news for the economy to come from the policy side in this year, mainly because there is the urgency to really meet the 5% GDP growth targets, and currently China is not looking like it's going to meet that. So that's reason number one. The second one I said might be the elections and also the Fed rate cuts. So what's happening in the US? And now we got the Fed rate cuts. Next up, elections. I think we can expect a little bit more stimulus to come. And by the way, I don't think this one is actually the most bullish part about what's been declared today. Because basically, liquidity terms and rates have been kind of really on the let's say positive side for China for a while now, and it's been the problem that people would not take on debt or use the liquidity because there has been not a good sentiment in the economy. So whether or not this is really the main takeaway, I'm unsure. I would rather divert my attention to this piece, which is also part of the plans that I've announced, which is that the PBOC, so the People's Bank of China, to set up a 71 billion swap facility to prop up the stock market. Now this breaks fundamentally with some of the narratives out there that China doesn't care about the stock market. There are communists after all, right? And that China doesn't care about the economy and stuff. But this one is basically putting on, one could almost say, leverage to fund the stock market. And that's possibly the reaction that we see in the markets today. And I think that's much more responsible for that than rate cuts and the other measures that they have taken here, like the reserve requirement ratios and so on. So what is interesting here is because I think this adds a lot to the long-term picture of what China needs to do, in my point of view. So this is the mix of assets owned by Chinese, and as you can see, the vast part of it, more than 60%, is actually in homes. And as we know, China is trying to deleverage the sector of the asset bubble in home prices, which have skyrocketed, and it's making housing not affordable for living. And if you take homes, cars and cash, you're getting quickly to 80% of the net worth of Chinese is being in those assets, which are not productive assets, which are actually more like liabilities. And now with the shift away from real estate, actually even the price comes under pressure, right? So what I think, and I mean, I'm not saying I'm smarter than the people running China in terms of the economic advisors and the policymakers, but what my perspective is, if they want to diversify out of this and make it more like the US economy, which is more based in stocks than the house prices or the house assets overall, then they would need to make stock markets less volatile, more predictable, and also in the long term, sort of what we see with the QQQ and the SPY and so on, so the S&P 500 going up over time. And currently, obviously, if we zoom out, like what's the HSI been doing? Oh, by the way, here, that's how it's reacted under Trump versus Biden. Goes to show that Biden has been very hawkish on China. But anyways, like, you want to see a continuous trend going up here in the HSI over time, and also the Chinese stock indices. Otherwise, there is no trust in, allocation to stocks, basically. And, with this plan, it sounds to me if the buying is becoming more orchestrated, because PBOC liquidity is directly available to those institutions to buy up the stock market. Plus, what I hope China would do is institutionalizing also the social insurances more, like establishing something like 401ks, like employee contributions into the stock market, building up a European-style welfare system that is partly also investing into the stock markets and so on. So over time, basically creating more liquidity, more buying pressure, and also more ownership, importantly, by mainland Chinese into their stocks. And I'm not talking only A shares and H shares, but also the tech companies that are listed overseas sometimes. That would be a great plan, in my opinion, and would contribute to the goal that Li Qiang has announced, that they want to grow the middle class from 400 to 800 million people over time. And I think that's not possible with, a ownership asset structure that is looking like this currently, where it's too dependent on the real estate market, where the asset prices for the real estate have created problems with family foundation and so on. Where they really need to find solutions that are different. And I think one way of doing that is this first step here. I think they also have some technicalities to solve. Like, for example, we've seen quite recently with Alibaba is now being, connected to the mainland stock markets via Stock Connect. So basically, Chinese mainland owners or investors can now start buying up Alibaba shares through the Stock Connect in Hong Kong. I think this should be hopefully in the future available for not only funds, institutional investors and some ETF products and so on, but more on a broader scale, also for more stocks, including maybe NIO and so on. Large part of the Chinese investors even today cannot access these products, but I think, a vast of this investment over time might still come from institutional ownerships anyways. That needs to be set up like this, and what I said before with 401ks, welfare system, security, pensions buying and so on. And with that, it could actually become a really long-term solution that the stock market is becoming more and more important in China. And that overall would lead also then, if the stock allocation is higher for Chinese and they see the stock markets going up, that they also see the increase in wealth. You will see the wealth effect that we are currently already having in the US. And therefore, this would help a great deal also with the consumption, in my opinion, and the consumer sentiment over time. But this is a long-term process. I'm just saying that I think we're seeing the first steps here, and I'm hopefully right on that this is the plan behind everything that they're announcing right now, and this is also the views of the people who are managing this behind that. And in that regard, we need to see also that China does have the means in order to push through with something like that. They have 5 trillion USD in cash USD savings. That's going beyond what the households even have in savings and stuff, which is also very high, by the way. And additionally, they're also creating 100 billion in monthly surpluses in trade. So long story short, China should diversify in more higher yielding assets, and stocks should be part of that. And now they should think about how they can find the right ways and mechanisms to make that become true. I read today's announcement as this is being part of that, especially at the current low valuations of Chinese stocks. It's a no-brainer for the Chinese to actually buy this up and own it, right? If the foreign investors are unwilling to do so. that's just my views. I think that's explaining parts of today's move in the pre-market. We'll see whether or not it holds, but very bullish signals here overnight out of China. Thanks for watching and see you in my next videos.